Welcome to the Altruistic Libertarian, advocate for a genuinely free society. I'm Anthony Wheeler, and today we continue our series on pervasive intervention. Manipulating the money supply is one of the more complex and opaque methods of government intervention. Few in the electorate understand monetary manipulations or their consequences, and too many professional economists subscribe to various forms of it. At one time, most professionals agreed that inflating the money supply damaged the economy. But then John Maynard Keynes changed that, giving policymakers a credible recipe for managing the economy. Quote, "Some call for measures in support of the supply side of the economy. Others want government to keep up demand, if need be, by deficit spending. Both groups in fact agree on the mechanics that Keynes described in his epoch-making General Theory of Employment, Interest and Money." Unquote. Modern Keynesianism advocates the use of taxation and or government spending, two major components of government intervention, to impact the economy. This is how Milton Friedman characterized the impact of Keynes. Quote, "Emphasis shifted to fiscal measures, to influencing economic activity by government expenditure and taxation. Deficit spending, pump priming, and public works, not central bank policy, were widely regarded as the means to recovery." Unquote. But Keynes was addressing a historically specific circumstance and not asserting a suite of policy options that would be universally applicable. In 1936, when the General Theory was published, the Great Depression was in its 7th year. About a third of the money supply in the U.S. had been destroyed, leading to a major deflation. Prices plummeted, as fewer dollars were available to purchase the same amount of goods, thereby increasing the value of each dollar. This in turn led to increased unemployment for reasons described below, which led to fewer goods produced, which led to continuing economic decline. With that in mind, Keynes wrote, and I quote, "Now ordinary experience tells us, beyond doubt, that a situation where labor stipulates, within limits, for a money wage rather than a real wage, so far from being a mere possibility, is the normal case. Whilst workers will usually resist a reduction of money wages, it is not their practice to withdraw their labor whenever there is a rise in the price of wage goods. It is sometimes said that it would be illogical for labor to resist a reduction of money wages, but not to resist a reduction of real wages." Unquote. With the advent of deflation, existing labor enjoyed an increase in their standard of living due to the increasing value of their paycheck. The employers, on the other hand, were facing lower revenues due to falling prices, putting a strain on their business. To remain viable, they had to lower wages or reduce their workforce. Again, Keynes, quote, "Since there is imperfect mobility of labor, and wages do not tend to an exact equality of net advantages in different occupations, any individual or group of individuals who consent to a reduction of money wages relatively to others will suffer a relative reduction in real wages, which is a sufficient justification for them to resist it. On the other hand, it would be impracticable to resist every reduction of real wages, due to a change in the purchasing power of money which affects all workers alike." Unquote. To favorably impact these circumstances, Keynes proposed an increase in government spending, thereby inflating the money supply so that prices would increase. Doing so would erode the value of each dollar, raise the cost of living, and decrease actual wages, yet wouldn't lead to additional unemployment. Quote, "Every trade union will put up some resistance to a cut in money wages, however small. But since no trade union would dream of striking on every occasion to a rise of the cost of living, they do not raise the obstacle to any increase in aggregate employment which is attributed to them by the classical school." Unquote. This summarizes the genius of Keynes, while highlighting the inapplicability of applying the same policies in a complex economy with a steadily increasing money supply due to government deficit spending. This became perfectly clear in the stagflation of the late 70s, where both inflation and unemployment rose to unacceptable levels, a circumstance modern Keynesians considered impossible. One of the more insidious forms of government intervention is increasing the money supply through deficit spending. When the government spends more than they collect in taxes, they either borrow money by selling bonds to cover the deficit or print more currency, or both. Printing more currency increases the money supply and reduces the value of existing currency in circulation, raising the overall price level. This is commonly known as inflation. Quote, a general rise in prices can only occur if there is either a drop in the supply of all commodities or an increase in the supply of money, unquote. Given the general rarity of a drop in the supply of all commodities, inflation can generally be attributed to excessive government spending. Milton Friedman provides the following sequence related to inflation. And I quote, after an increase in the quantity of money, prices rise, velocities of circulation increase, the rate of interest rises but not sufficiently, profits increase, loans expand, and the real volume of trade increases. Deposit currency expands relative to money, prices continue to rise, that is, phenomenon number one is repeated, then number two is repeated, and so on, unquote. Friedman goes on to describe the impact of an inflationary cycle on industry. Quote, an increase in demand will produce a new market equilibrium involving a higher price but at the same quantity. The higher price will, in the short run, encourage existing producers to produce more with their existing plants, thus raising quantity and bringing prices back down toward the original level, and, in the long run, attract new producers and encourage existing producers to expand their plants, still further raising quantities and lowering prices, unquote. In this simplified version of events, in an inflationary cycle, people and businesses across the economy make poor spending and investment decisions, resulting in capital consumption. Quote, first, inflationary or expansionist policy must result in overconsumption on the one hand and malinvestment on the other. It thus squanders capital and impairs the future state of want satisfaction, unquote. When capital is consumed, productivity and thus production eventually declines. This provides a temporary appearance of economic growth. It seems like incomes are rising along with profits. But this is an illusion, and when a certain point is reached, it becomes apparent to the economy that malinvestment has been made and the necessary adjustment is called a recession. This may seem counterintuitive, but imagine for a moment a family farm with cows, chickens, and wheat fields. They harvest the wheat, store seed stock for the coming year, and sell the rest. They produce a quantity of eggs based on how many laying hens they keep. They milk cows every day and sell the surplus on the local market. Every year they raise beef cattle from calves born in the spring. In this scenario, the dairy cows, laying hens, beef cows, and the single bull, and seed stock can be considered capital, as these animals and seeds will, over time, produce that much more of the same, that is, production. But let's imagine that inflation takes place, and come fall, the selling price for grain, beef cattle, and laying hen encourages the farmer to sell off some of the capital, realizing with the sale increased profit levels. See Friedman's example above. In addition, during the winter, they consume some of their seed stock, homemade bread, beer, roast half of their laying hens, and slaughter several heads of calf-bearing beef, believing they can be replaced at current prices. Thus, consuming part of their capital, that is, resources intended to increase more resources, temporarily creates the appearance of prosperity and economic expansion. Come spring, they discover that the price of seed stock has risen due to ongoing inflation and the increased demand for such items in season, and they didn't budget enough financial resources, having already spent a portion of their fall profits. As a result, they don't have enough seed stock to plant every field, having consumed a portion of it. Egg production is way down as they have fewer egg-laying hens and no money to purchase more. And they get half as many spring calves as they projected. In this example, they kept the dairy cow, so milk production remains at former levels. Adjustments must be made as farm production declines. This is the recession when it occurs in every industry at the same time. In a complex commercial environment, the causal links are obscured, and spending and investment mistakes are made across the economy, leading to the inevitable adjustment. This is otherwise known as the business cycle, periodic waves of economic growth and recession. Thus, changes in the money supply that don't match economic growth result in inflation or deflation. Up until the early 20th century, before suitable monetary controls were established, radical changes in the money supply could happen for any number of reasons, such as the discovery of new gold, for instance. Private banks issued their own currency, and international movements of commodities and then changing exchange rates could impact national money supplies and therefore their economies. In modern times, past 80 years or so, the government has developed the institutions and the understanding to manage a stable money supply. But they typically fail to do so, as the government generally spends more than they receive in tax revenue and thereby increase the money supply, resulting in a continuing roller coaster of an economy as the inflation continues and we see periods of expansion inevitably followed by recession. This is not caused by any particular industry or technology or international event. This is caused by increasing the money supply. As money is the only thing, the only commodity, the only force that touches every purchase, every sale, every investment, every salary, every loan, every industry, every employer, every employee, and every black marketeer. Only money. The only thing that can impact the entire economy in a negative manner at any given time. The only thing that can cause a recession, depression, or contraction outside of war or a major natural catastrophe. Inflation is particularly hard on fixed incomes and can result in a lowering of real wages absent continuous increases that match rising costs. Yet not all groups are affected equally. Quote, "The objective of credit expansion is to favor the interest of some groups of the population at the expense of others. This is, of course, the best that interventionism can attain when it does not hurt the interest of all groups. But while making the whole community poorer, it may still enrich some strata." Unquote. When the government doesn't print more currency to cover the deficit, they borrow money. This generally takes the form of treasury bonds. When the government borrows from capital markets, they consume a portion of savings that would otherwise be invested in productive ways. This is critical because, and I quote, "Saving and the resulting accumulation of capital goods are at the beginning of every attempt to improve the material conditions of man. They are the foundation of human civilization. Without saving and capital accumulation, there could not be any striving toward non-material ends." Unquote. The only way society creates new wealth is through the productive application of capital towards increases in productivity. The only source of new capital is saving. Quote, "That amount which can be consumed within a definite period without lowering the capital is called income. If consumption exceeds the income available, the difference is called capital consumption. If the income available is greater than the amount consumed, the difference is called saving." Unquote. Whenever the government levies taxes, borrows from capital markets, or prints more currency, less capital becomes available for productive investment and the entire economy becomes relatively poor. Where free markets infuse promising enterprises with life-giving capital, governments directly consume wealth in the form of national defense, direct transfers such as Social Security and welfare, where wealth is immediately consumed and not invested, and administrative costs that also act to inhibit innovation and wealth creation, such as the FDA and DEA, and actual investments with poor or undetermined returns, such as infrastructure, highways, bridges, and public education. Though this concludes our show for today, in our next episode we continue our discussion of pervasive intervention. Until then, peace.